Most people picture Coinbase as a digital grocery store for crypto. You log in, pick up a fraction of a Bitcoin, and leave. But that model misunderstands how the money actually flows. Disclaimer: this video is for educational purposes only and is not financial advice. In reality, Coinbase operates as a highly regulated border crossing between the traditional fiat banking system and the decentralized on-chain economy. Every time fiat currency moves into crypto, or crypto moves back into fiat, they charge a toll for using the bridge. Look closely at who actually pays that toll, and a sharp asymmetry appears. The traffic crossing this bridge is split into two distinct groups: institutional whales moving billions, and retail tourists buying a few $100s. Institutions push $982 billion across the bridge, paying a microscopic 0.05% rate to generate a tiny sliver of revenue. Meanwhile, retail users trade just a quarter of the volume, but pay a 1.4% rate, creating $3.3 billion in revenue. The math dictates the reality of the business. 80% of the volume is wholesale traffic, moving almost for free. At its core, Coinbase is a retail business disguised as an institutional exchange. It survives because that 20% of retail traffic pays the premium. But that vital retail premium is currently melting down. Retail users are getting smarter, migrating to cheaper advanced trading tiers or competitors offering zero-fee execution. To stop this bleed, Coinbase launched the June 2026 Everything Exchange. This survival sprint gives retail users completely new, exclusive reasons to stay and trade. Take a look at the SpaceX launch. Historically, retail investors had to wait years for companies like SpaceX or OpenAI to go public before buying. Coinbase is now offering retail users pre-IPO perpetual futures, granting early exposure to highly valued private companies before they ever hit the traditional stock market. They also deployed true one-for-one on-chain tokenized stocks. Users can buy real equity shares and receive actual dividends, and then use those shares as collateral for loans directly on the blockchain, tracking it all through modular, Bloomberg-style layouts. Expanding the menu of assets keeps users clicking buy and sell, but it leaves the core vulnerability intact. Trading revenue is violently cyclical. When a crypto winter sets in and retail users lose interest, the border post starves. To survive those frozen markets, Coinbase relies on a second, entirely different engine. They generate billions from the massive amount of customer cargo left parked inside their vault. This document details their partnership with Circle. For every USDC backed by Treasury bills, Coinbase earns interest on the underlying fiat. They keep 100% of the yield on platform and split it 50-50 outside. Stablecoin revenue totaled $1.35 billion. Look at the Federal Reserve building. Because $1.35 billion comes from Treasury yields, Coinbase operates as a leveraged bet on U.S. monetary policy. If the Fed raises rates, Coinbase prints money. If the Fed cuts rates, this revenue line drops, regardless of what Bitcoin is doing. Trapping this lucrative fiat float inside their own ecosystem is now the company's highest strategic priority. Every dollar a user leaves sitting idle on the platform is a dollar earning them yield. To lock that liquidity in place, they are rolling out a full consumer banking suite. They launched a Coinbase One credit card secured directly by USDC, allowing users to bypass legacy FICO credit scoring models entirely while earning Bitcoin rewards on every daily purchase. Once those assets are on the platform, users never have to sell them to access cash. They can now take out instant loans against their staked crypto collateral, maintaining their market exposure while borrowing liquid funds. Look at the Fannie Mae building. This represents the ultimate lock-in product. Coinbase secured partnerships to offer the first-ever crypto-backed home mortgages accepted by traditional financial institutions. Users pledge Bitcoin instead of a cash down payment, and the assets sit in escrow, gaining value for the user while generating persistent yield for the platform. While they build the bank, they are also building the underlying roads. Their base Layer 2 network provides the blockchain infrastructure for these transactions, successfully settling over $19 trillion in volume with sub-second speeds and microscopic fees. They expanded these roads for enterprise clients in June 2026, rolling out private ledgers to guarantee regulatory compliance for corporate transactions, alongside AI agents programmed to execute trades and settle cross-border payments autonomously. By acting as both the consumer bank holding the assets and the blockchain highway processing the data, Coinbase extracts foundational value from every financial action. They want to hold your mortgage, process your payments, and permanently lock in your float. Executing this strategy requires navigating a hostile regulatory environment. In 2025, the Genius Act legitimized stablecoins at the federal level, but it aggressively prohibited issuers from paying interest directly to coin holders. Look at Jamie Dimon. That strict legal clarity creates an opening for legacy banking titans with pristine reputations to issue their own enterprise stablecoins, directly challenging Coinbase for the corporate float. On the other side of the spectrum, watch this speedboat bypass the shipping port. Decentralized exchanges, or DEXs, represent a different threat. They allow users to trade wallet to wallet through code, bypassing the border post entirely. Coinbase is fighting a multi-front war. They have to defend their retail trading margins against friction-free tech speedboats, while defending their institutional float from traditional Wall Street banks. This table breaks down the precarious dual nature of the empire. Hat 1, an exchange reliant on tolls, alongside Hat 2, a vault reliant on yields. Look at what pushes it down. The exchange is vulnerable to cold markets, the vault to Fed rate cuts. This exposes a nightmare scenario for the company's long-term valuation, a situation known as the malignant coincidence. A malignant coincidence happens when a harsh crypto winter crushes trading volume at the exact same time the Federal Reserve slashes interest rates. The retail tolls dry up, and the institutional float is wiped out simultaneously. The frantic June 2026 sprint into mortgages, AI agents, and pre-IPO futures is an attempt to build an unassailable financial ecosystem before that scenario triggers. The question is whether they can pave the roads fast enough, or if these primary macroeconomic forces will inevitably catch up and pull the entire empire back to earth.